Welcome to the Three Corners Capital monthly briefing. Thanks for joining us. I'm Chris Flores, and with me is my partner, Steve Fortin.
Hello.
And today we're talking about things that we're experiencing and seeing in the marketplace, the economy, and how that is informing our conversations with clients and investors.
hmm
We're really going to talk about three things today. We're going to talk about kind of what I'll just broadly refer to as market sentiment, but we're going to look at some recent IPOs and this idea of FOMO. We're going to talk about market volatility and just how we're starting to see some rotation between growth names and value names. And we're going to talk about inflation and the Fed. Yesterday was a big announcement that the market is digesting, so we'll
hmm
go into that. But otherwise, we'll kick things off. So the first thing that we wanted to kind of level set with everybody is just how we feel about the markets. And obviously we have our day-to-day, feelings around the markets, portfolio construction, the economy, but so do our clients, so do the people that we're talking to. And it's really easy to be inundated with news and information that can seem, either get us really excited, get us really fearful. And I wanted to just use this slide of SpaceX,
hmm
big IPO recently. And this is not a commentary on SpaceX at all. It's not a buy recommendation or a sell recommendation. For all intents and purposes, what they're doing could have some really big and important consequence for, our society. But what I think is really important is to underscore kind of what the IPO market tells investors and helps inform us. And the first thing I'd want to note is that this year, what's been healthy, I think, to see is we're at about $140 billion of IPO proceeds. And that puts us only about $2 billion away from a full year record. And we're just now almost through July.
Right.
And that suggests that there is strong capital market activity and investors are willing to provide capital. So there are some underlying positives that exist. What I think is important for investors to know is that the downside is, sometimes that these IPOs reflect optimistic assumptions.
For sure.
And this kind of activity that we're seeing isn't that these companies don't have momentum. It's not that they're not involved in themes that are long-term trends that we believe will exist, but it's when these companies start to have valuations that can't support that price. And I think that's part of what you're seeing here with SpaceX. You had a lot of excitement, a lot of FOMO, people, the fear of missing out. There's been so much, really since the pandemic when there was the whole, Reddit users, and making, all this money off of trades and all of these kind of things. And I think everybody's waiting for that next big thing and you want to participate in it. But again, these companies, and especially in these hot themes, are being priced for perfection. And the concern and what we're seeing, I think, in the SpaceX example isn't that it can't be a great company. It's just that the valuation has to come back in alignment with where the business really is. And again, doesn't mean that won't long-term be a thing, but I think it's just important as investors, as we're working with people, to be reminded, we all want the big returns. We all want to experience those wild successes, but it can come at an expense. And when we're chasing it, that can be a problem.
Yeah, for sure. And as you can see in the chart, SpaceX went straight up for a few days and then came back down pretty dramatically, and erased more than 1.2 trillion in value from their peak. And so, there are not many shares available. Great numbers of investors wanting to buy the shares. Is kind of almost predictable what's going to happen. And you just can see in the chart, down quite significantly from the IPO price. So, could be a great long-term investment. Don't know yet. Lots of enthusiasm around building data centers, in space. Whether or not that, happens and when, the Elon Musk is famous for, making promises that take much longer to be nearly fulfilled, if at all. So we shall see, but it's just another great example of, too much froth and fear of missing out. And Chris, I know you wanted to speak about the Bank of America bull and bear slide as well.
Yeah, this is really interesting, and it's always fun because there's slides that we could share that kind of support another another case. But this is a research that Bank of America puts out, and it represents the buy and sell side of brokers. And when there's a high recommendation to buy, that represents this bullishness for the market. And that is a contrarian signal. It's actually a signal that if there's extreme bullishness on the buy side, that actually might mean that investors should take some caution. And you can see how this has transpired over past years. And it's not a guarantee that it's exactly going to predict something, but it is worth noting that, in these cycles where there's excitement, there's exuberance, it does warrant some questioning around, hey, are we missing something? Is there something else that's going on? And I think that's where, when we'll get into later in our conversation today is why you're starting to see investors rotate from maybe some of these big technology companies that have done really well into other types of companies that are great companies, but maybe, with different valuations.
Right. So let's talk a little bit more about artificial intelligence. That is a huge driver of the global economy and the global markets. As you can see on this slide, it's quite remarkable that, for example, on the far left, of all the South Korea earnings recently over the past 12 months or so, two companies represent 76% of the earnings, and that's Samsung and SK Hynix. We've all heard of Samsung. Maybe, most of you haven't heard of SK Hynix, which is a well-known in investor circles, semiconductor company in South Korea. And semiconductors have just been, in huge demand with the build out of artificial intelligence. You look at the next bar, second from the left, looking at all of Taiwan and the fact that TSMC, their biggest company, making really sophisticated equipment to make semiconductors, is a huge part of their earnings. And then the next three bars are showing, U.S. earnings, U.S. capital expenditures related to AI. And finally, on the far right, our gross domestic product, our economy, totaling up all the goods and services. Artificial intelligence is estimated to be 40% of, the last 12 months gross domestic product. So it's a huge theme, huge opportunities, and investors are very excited. The next slide really speaks to that as well. We talk about market concentration, and you think of the big, technology companies in the U.S., which is that bar on the far left. But what a lot of people have noticed recently is that in emerging markets, which include South Korea, several other, Asian economies and other parts of the world where, there's huge concentration showing up now as well. You look at, the three companies in the emerging markets index, TSMC, Samsung, and SK Hynix, as we mentioned earlier, those three representing over 30% of the whole index. And so, the message here is that, concentration is kind of a natural thing as companies, become so big and their earnings are so powerful. But as prudent investors, as, responsible managers of clients' money, we have to look at other parts of the market as well and recognize that the volatility can come back to bite you at some of these concentrations.
And I think that's where a lot of times in our conversations with people, there's this active management versus passive management debate. So do you try to pick and choose the portfolio, or do you just buy the market, buy the index? And there's so much money in passive investments. And this is not, we have a passive core approach. So we believe in utilizing passive strategies as a part of a portfolio. But what people don't always understand is, hey, just go buy the S&P 500, just go buy an emerging market index. But you don't realize how much you're relying on just a few companies to drive a lot of the returns of that index. And so if those companies don't deliver, or the market sentiment changes, you can start to see those indices, maybe underperform something that owns some more broadly diversified positions. And I think that's something that investors should be, considerate of.
Right. And then on the next slide, continuing on with global equities, it's really been remarkable to see Asian semiconductors, as we mentioned. Look at the green line on this chart. Just in the past, 6 months or so, really kind of shooting up as money just flooded into these semiconductor companies in Asia, and you can see the painful drawdown recently. But other themes: European aerospace and defense, developed market banks that are benefiting from all of the build out, not just of artificial intelligence, but this the theme of reshoring manufacturing, not just in the U.S. but Europe trying to build out their manufacturing base and their national security and so forth. And what's remarkable on this slide is that U.S. growth since, and this chart is looking at since October of 2022, which was a low point recently. U.S. growth has more than doubled, but these other themes have quadrupled.
Mm-hmm.
And so it's just just a reminder, just an indicator of how much enthusiasm there is out there, but also a lot of volatility underneath the surface.
Yeah, absolutely. Yeah, and that's why you're starting to see, investors, transition their thinking from, these big thematic trends into other areas of the market. And it's not without noting, as this slide shows, I mean, part of where we've been is earnings growth has been healthy. These companies have been earning, and profit margins have been growing, and that's a good thing. And the market's been rewarding these companies for that. So we don't want to be dismissive of that and how that can be impactful. I don't know if there's anything else that you wanted to add.
Well, yeah, I think the remarkable thing on this slide is that box in the upper left showing 2026 earnings growth versus and the components of that versus the last 25 years. The last 25 years earnings growth has averaged 7.6%, and this year over 27% earnings growth. And then on the right side of this chart, you can see the profit margins just going through the roof in recent times. And, a 17% or 16% profit margin is huge. And that's, generating a lot of investor excitement and enthusiasm. Just looking back to before the great financial crisis, the light gray line on that chart, profit margins were between 10 and 11%, and that was considered to be really, really good. So a lot of enthusiasm and a lot of profit margins have been really healthy for not just technology companies, but other companies as well. As you can see on this slide, we like to talk about value versus growth. And what's remarkable, on the bottom right is that value, the price to earnings discount that value typically has versus growth has really shot up. And that's a healthy thing because that means companies in other industries, as you can see on the left side of the chart, whether it's energy, financials, materials, industrials, they're also making good money, good profit margins. What's noteworthy, of course, energy, a huge earnings growth on the left, having to do with oil skyrocketing due to the Middle East war.
Yeah. Yeah, and that's always an interesting thing, not to get into a whole energy conversation, but one of the challenges with that sector is you can have a great management team, but the commodity price is really going to drive a lot of the financial result. And obviously, as we know, that can be a really volatile commodity price depending on what's going on. And so, again, I think that's where we're in this period of time where diversification matters. We need to be conscious of the fundamentals and recognizing that there are some long-term trends that we can follow. And I think one of the things that's been really helpful for diversified investors this year is that we've seen that performance shift. So for the last several years, really since the lows of the 2022, you saw the technology companies sell off way more than the rest of the market in that period of time. But the recovery since then has been really strong for them. This year, and we've started to see this rotation a little bit in last year, but if you look at the S&P 500, and you break that out between just the Magnificent Seven, so the top 7 stocks versus the 493 others, this year, The Max 7's up about 1%, and the 493 are up about 12.
Mm-hmm.
So, and we're seeing this in other indices. If you look at the Russell 1000 growth versus the Russell 1000 value, that story is the same.
Right.
And that is a helpful sign. We've seen international perform well. We've seen small caps perform better. We've seen real estate perform better. And I think, again, when we're building diversified portfolios for clients, there's periods of time you're like, yeah, why don't we just own all of this? But we're really positioning those portfolios for kind of an enduring future, so that we're not having to always try to guess what's going to happen in the world that nobody can predict.
Right. Or when that's going to happen, because the market can rotate capital very quickly. But another encouraging sign is on this slide. This is looking at market concentration on the left, but more importantly on the right, there are, two ways to measure the S&P 500. There's the normal market cap weighted, so that the biggest companies, have the most weight in the index calculation. But there's also the equal weight S&P 500, where every company, their stock performance is equally weighted in the index's overall performance. And in the blue there, you can see, going back to the early 90s, there have been many stretches where the equal weight index outperformed the market cap weight. And recently, it's not shown on this slide because it's looking at 1-year rolling returns. But over the past few months, the equal weight index has done better than the market cap index, and hit a new all-time high just recently. So that's another encouraging sign that we like to see in the market. So let's transition to inflation, one of our favorite topics, and I'm sure our clients' favorite topics as well. You can see on this slide, we've shown this before. We've had a tick up, due to a number of factors, mainly the war in the Middle East, but also tariffs. And I would mention just the overall demand in the economy, whether it's related to AI or reshoring activity, or just robust consumer spending. Inflation has reared its ugly head again. And the bond market is not liking it. As you can see on the next slide, this is looking at, the Fed and interest rates. And on the far right, you can see the blue was the Federal Open Market Committee's year-end expectations for the short-term interest rates. And they were, as you can see, trending down. But given all the changes I just mentioned, now the market is expecting, those green dots on the chart, so an increase in rates. And, yesterday the Fed just came out with their announcement after their 2-day meeting that they're holding rates unchanged, which was largely expected. However, there was a kind of a 30% probability priced into the market that the Fed would actually raise rates, because the new chairman, Kevin Warsh, has been so aggressive about, saying we're going to, fight inflation. We're going to get it down to 2%. But he's also been very vocal that his philosophy is not to telegraph what the Fed's going to do. And so when they came out and with his press conference, the reaction in the bond market was, immediately not that good. Saying, okay, is this guy really going to fight inflation? How strong is he, convicted with that? And so that sent yields, higher. The bond market, sold off, really not happy with the words about inflation, fighting inflation. So we shall see, with the bond market. And the reason why we talk about the exciting bond market is because of the yield curve. You wanted to talk about the yield curve.
What is the yield curve, Steve, for those that are just dummies like me?
Well, it's this is the U.S. Treasury yield curve. And so, the safest bond market in the world, arguably. And you can see just since the end of the year, the yield curve has, raised up dramatically from the short end all the way to the long end. And that's a function of, the market worried about inflation, and worried about, fiscal spending in our country and things along that line. So, this is not good, for consumers who are looking to refinance or looking to get a new mortgage, buy a house. So this is something, we're monitoring closely. But, the good news is for clients who have a, considerable portion of their money in the bond market, there are higher rates available. However, you're also paying at higher inflation. So it's kind of a wash.
Yeah. I think one of the good things, though, that's happened in this is we've started to see that short end come down a little bit. So this looks a little bit more like a normal yield curve where, and again, for those that aren't as familiar, when you lend money, you for a short time, you expect a little bit lower, return for that versus the long end of that. If you're going to lend the government money for a long period of time, you expect more return. And in recent years, we had seen that short end significantly higher, and that's called an inversion. And so that's been a gradual process of trying to, quote unquote, normalize rates. But again, with that higher end being, the longer end being higher, again, banks are lending money out, and that impacts us. The overnight rates that the Fed charges doesn't necessarily drive as much of the long-term impact. And so again, we can really see inflation potentially being sticky. The cost to consumers not as attractive right now. But there are other implications of higher rates in a positive way for a consumer, whether that's through their own, savings or, other mechanisms that exist out there. So, we're mindful of it, obviously, as it relates to, recommendations we make.
So with that, we hope you enjoyed this month's briefing, and let us know if you have any questions. Thank you very much.